Okay, those are some individual trading ideas. Let's talk about the debutante on Dalal Street, Elin Electronics. It's been a muted debut. The stock is currently down close to about 7%. To talk more about the company, its business model, and the key takeaways from the conversation that we had with the management, Vahishta joins us for more. Vahishta?
Hi, Rima. Thanks for that. Just like you mentioned, Elin Electronics has had a very weak listing on the markets today. In fact, it listed at 244 rupees per share, which is to be compared with the issue price of 247 rupees. And the stock is down by about 6-7%, like you mentioned. Let me brief you a little bit about the basics of the company, which is an electronic system design and manufacturing services company for major brands of the lighting, fans, kitchen appliances in India, which includes the likes of Philips, Panasonic, Usha, Havells, Bosch, etc. Now, the key business verticals include fractional horsepower motors, and it was also ventured into the medical diagnostics cartridges. Now, the company serves under both the business models, which is the ODM as well as the OEM business model. Now, post-merger, the promoter and promoter group shareholding has fallen to 32.93%, which prior to the listing on the exchanges was at 53.98%, and post-issue the market cap comes to approximately 1,200 crores. Now, the proceeds of the IPO are expected to be utilized for repayments of their debt, for general corporate expenses, and for funding their capex at their Ghaziabad as well as the Goa plant. Now, in terms of peer comparisons, competitors like your Amber Enterprises or Dixon Technologies have much higher revenues than Elin Electronics. In fact, Elin Electronics clocked revenues of approximately 1,100 crores in FY22 with margins in the range of 7-7.5%. We hosted the management on our channel today morning, and they had said that they expect to clock 1,800 to 1,200 crores of revenues in the next 3 years. And if this is to be achieved, the company needs to grow at 22% on a year-on-year basis for the next 3 years. This is to be compared with 27% growth, which they clocked in FY22 per annum, and they clocked approximately 10% growth in FY21, though that was a COVID year, so there was a lull over there. Also, the company plans to gain from the e-retail segment in the small appliances business, and they plan to expand the BLDC electric vehicle motor business, which is an extension to their existing business. Also, backward integration has helped the company to deliver better margins than their peers. Historically, the EBITDA margins, like I mentioned, have been in the range of 7-7.5%. In fact, the company is confident of maintaining the same range, or even optimistic of improving these margin range. So all in all, a robust business model with attractive valuations, although saw a weak listing on the markets today. Back to you.
In our small appliance division, we intend to increase our sale of mixer grinders, irons, and we want to tap the e-retail business in this category because that's again another fast-growing category. Personal trimmers is another division where we want to expand, and we have very healthy orders. Motors is a major business vertical for us, so we are looking at BLDC motors, especially for the two-wheelers and three-wheeler category. That's a fast-growing category. Right now, a lot of motors are being imported, and since we are already in BLDC in ceiling fans and mixer grinders, that's a natural extension for us because the technology is already with us. So that's the EV space which we want to come out in.
That's the new target area for the company, providing motors for electric vehicle 2 and 3-wheelers. But most of the recent debuts on the Dalal Street have been muted. Even Sula Vineyards, KFin Technology, and now even Electronics, all of them are trading lower than their issue price. Market expert Prakash Diwan